Good afternoon, traders. You're speaking with Will, who is the head trader at WH Investments Group Limited. And we've been placing Forex signals for just over a month now. I do have a couple of years of financial experience within the markets. So yes, let's just get straight into this video, whereby we'll be discussing risk management and why and how it is so crucial to trading Forex and making money within the financial markets. So it's much easier if we just take it straight into an example. So let's imagine you've got a £10,000 account as noted here, and I've just gone and released a trade signal that has got a 93 pip stop loss. So you're probably wondering, what lot size do I do and how can we place a trade so it's not going to be crazy to your account, let's say. So in my first example, I always recommend using 1.25 risk management, and I will go into more of this in the second half of the video. So if we just start with a basic example so we get the principle behind the idea. So what we would do is we'd get the account balance and we would times it by the percentage of the risk management which you would wish to use. Now in this example, as a starter position, I do highly recommend using 1.25% as your first starter position for risk management. And if we times £10,000 by this percentage, we would get £125. Now after this, all we would need to do is divide this number by the stop loss in pips. Now in this trade signal which we are going through, it had a 93 pip stop loss, so I'm just literally using this example here. So what we would do is £125 divided by 93 pips, and this would be the lot size which you would then go and place on MetaTrader. I don't know why that says different. I'll change that. So this position, obviously, this is just I would say this is a maximum you would be looking to place. You can place a lot lower than this, but as a starter position, you should be placing no more lots than 1.28. Now, this would mean that if there was a drawdown within the account, the maximum, if this trade hit your stop loss, the maximum amount of money that you would lose is £125. Now this is very important as well, as usually we would use at a minimum a 3-to-1 risk to reward ratio. So this would mean that it would take 3 of our 3 bad trades to cancel out 1 good trade. So your win rate would literally have to be around 34% to make profit within the market. So that is how important it is. Now don't forget, obviously, let's say if we use a different signal and I had a stop loss of 4,234 pips, the maths would be much different. So if we take that, it would do 125 over 4234, and that position size would be 0.02. So obviously that is a big difference between 1.28. So make sure that you are doing this calculation every time we place a trade signal in the channel, as it is crucial to your account. Now secondly, I have gone and created a spreadsheet which does this all for you. So say for example you have a £500 account, then it would literally, look, do you see all of the figures change? You enter your account size, and let's say the stop loss of 93 pips, your first position would be 0.07 if you were using a 1.25% risk management strategy. So you're pretty much getting the idea. And don't forget, if you did want this spreadsheet, just drop me a message in the comment section or even on my Telegram or my Instagram, and I'm happy to send this spreadsheet to you. So let's actually take it to some charts so we can actually get a real principle of how to use this risk management strategy. So we'll go to the US dollar CAD, as that was our most recent signal, and we have already taken profits on this, although we probably should have kept it, but we like to take our profits and run. So we entered this at 11:44 on April the 27th. So if we just go to our date, April the 27th, 11:34. So we get 11:30. Right, so this was an actual trade and we've actually gone and closed this already. But let's say, for example, you wanted to enter multiple positions on this trade as you had a really high conviction and you just wanted to roll your stop loss, double up, and possibly even triple up. So let's say we entered at this line here, 1.40657. This is our first entry point, and price went and moved towards the downside. Now, what would be a very safe option to do would be to roll your stop loss to around this level here. It would be completely your choice, and so all this would mean that this would create your trade a risk-free, and you would have locked in 23 pips profit. Now then, if you wanted to double up on this particular trade, because you had a really high conviction that it was going to continue to go down like it did, you might want to enter more than 1.25%, because you've already gone and locked in 23 pips profit. So you're already in profit and you've got nothing to lose. So this is why your position sizes increase as you roll your stop loss and you make it a risk-free trade. You can increase your position size, double up, and then eventually triple up. And if you wanted to change these percentages here, that's completely up to you. These are just my percentages, which I use for my first, second, and first positions. So yes, I hope you get that idea. And then say if you entered, you could double up, and then obviously it would have come even more down, and you can lock in all of this profit. So all you would do is then move all of your stop losses below, and then you could enter again. So at this line here, if you entered again, and price then kept on going down, you could then move all of your stop losses to here, creating a risk-free scenario where you would be over leveraged. However, this would be a risk-free trade, as you would have locked in. Don't forget, we entered around 11:30. So we entered around it. You would have locked in 53 pips profit. You would have dedicated over 3.75% of your account to this trade. However, it would be completely for risk-free, as you have nothing to lose, as you've gone and moved your stop loss, and your stop loss is in profit. So this is a technique which I highly recommend using. Like, it is so good. All of the professionals at JP Morgan and all of them, as soon as they're in a strong profit, this is what they're doing. They're protecting their capital, and sometimes they don't even double up. It's just nice to roll your stop loss so you can go to bed and you know that this trade is a risk-free trade. So yes, traders, that was my explanation on the risk management strategies that we are using at WH Investments Group, and I highly recommend following these strategies, as if you didn't, I mean, it could be honestly disastrous to your account. People place huge trades and they can either make loads of money in even a matter of seconds. Sometimes they can make loads of money in a matter of half a day, or they can blow their account in half a day, and this is how you stop that. So yes, I highly recommend using 1.25% risk management for your starter positions. Now, I hope this made it clear. If it wasn't clear, feel free to drop me a message on my Instagram or even my Telegram, as I'm happy to help. Have a great day, traders.